All right, let's pick back up with the depreciation schedule. This is the way it looks at this point in time. We need to go to the next slide and see the changes. Here we have a couple of items. The boiler, which is showing 80% MFG, and the air filter is showing 100% MFG. So we have an asset that is also used in manufacturing. What we need to do is determine what percentage of the asset is being used for manufacturing and what is being used for, say, the office or some other aspect of business, because we want to split this and cost it out depending upon usage. So we've got, here's where we need to see what's going on. All right, so to review the basic journal entry for depreciation, we're debiting depreciation expense, crediting accumulated depreciation. However, if the asset is used in production, depreciation is recorded as a manufacturing expense, part of manufacturing overhead. So this should jog your memory as far as accounting 2, when we were looking at manufacturing and we had the work in process inventory. All right, so what we're going to do, the depreciation, that is the manufacturing expense portion, is going to be debited to work in process inventory. It's part of the manufacturing cost, and we will credit accumulated depreciation. So that's why in the previous slide, when we were looking at the boiler and the air filter, how much usage was for manufacturing, because the 80% for the boiler and the 100% for the air filter will need to be debited to work in process inventory. Now, keep in mind, allocation of overhead is beyond the scope of this course. There is another textbook that you can take if you want to pursue beyond this initial one, and that would be your manufacturing costing. But as far as the AIPB, the Certified Bookkeeper exam that we're targeting for and preparing for this course, we're not going to be concerned about the overhead. But do be aware of what we're doing here. The debit to work in process inventory, the credit to accumulated depreciation. All right, so looking at this, going back up and looking at the boiler, the 80% manufacturing, just recapping here, we had, those were the two that were partly manufacturing. The boiler is 80% and the air filter is 100% manufacturing. All right, we're still using straight line, and that's working out as the same way we would do the rest. All right, we need to have totals for the depreciable base, totals for the residual value, totals for the depreciation in prior years, and the depreciation for the year ending, as well as accumulated. All of this needs to be able to tie in, to be able to prove. So based on these amounts, the total property, plant, and equipment on the books should be $847,000. So that they're taking and they're pointing to the depreciable base total of $693,000 plus the total residual value of $154,000 is $847,000. So in property, you would have a subtotal, equipment a subtotal, vehicles a subtotal. Everything is going to match to a total of $847,000. The accumulated depreciation at the beginning of the year should be $324,000 on the books, in the accounting records. The 2009 depreciation will total $33,000. $18,000 of it is depreciation expense. The $15,000 refers to the boiler and the air filter. Those two items that add up to $15,000 in overhead. That goes to work in process expense, inventory, I should say. All right, let's look at units of production. The units of production method assigns a fixed amount of depreciation to each unit of output or service that the plant asset produces. To compute the depreciation per unit, Formula looks very similar to that for straight line. You take the original cost less the residual value and divide it by the estimated useful life. However, the difference here is the estimated useful life is in units, say in items produced or in miles driven. It's an estimated useful life in units rather than in years. So we get a depreciation rate per unit where we'll get dollars and cents per unit produced, per mile driven. Now, once again, they're reminding you that in the numerator of that fraction, cost less the residual value is the depreciable base. So to compute depreciation for the entire period, the entire fiscal or calendar year, we will take and multiply this per unit depreciation rate by the number of units produced for the period. So here we have an example of ARC Inc. Purchases a delivery van on January 1, 2001 for $22,000. The van has an estimated useful life of 100,000 miles. The company expects the van to have a trade-in value of $2,000 at the end of its useful life. There's our formula. We're going to substitute in. Cost is $22,000. Residual value is $2,000, leaving us a depreciable base of $20,000. The expected useful life in miles is 100,000, so we're taking 20,000 divided by 100,000, and that will yield 20 cents per mile. Now, this schedule, we need to know the number of miles driven. So year 1, they're showing 30,000, year 2, 27,000, year 3, 23,000, year 4, 20,000. It just so happens this totals to 100,000 miles. Now, in the real world, it's quite likely that we may have excessive miles above 100,000 in those 4 years, or we may have less, and we'll just continue depreciating, figuring the depreciation expense until we reach 100,000 miles total, because we cannot go over our depreciable base. So here's how we're going to work this. Take the number of miles driven times the 20 cents per mile rate, and the depreciation expense is showing in year 1 of 6,000. We're going to do that in year 2, in year 3, in year 4, and over there the accumulated depreciation has been increasing each year, because accumulated depreciation year 2, 11,400, is the 6,000 for year 1 plus the 5,400 for year 2. Year 3 takes the 11,400 for the first 2 years and adds 4,600 for that third year. So $20,000 is the accumulated depreciation at year 4. That equals the depreciable base. So this asset now is depreciated. Okay, year 1, here's what we're going to record. December 31st, 2001 for a calendar year end. Debit depreciation expense for the 6,000. That was the 30,000 times 20 cents a mile. And credit accumulated depreciation for 6,000. You can see it here posted to the T accounts. Year 2, 27,000, and there they've debited depreciation expense and credited accumulated depreciation. Depreciation expense is that account that is temporary and closes out at the end of each year. So we're only seeing 1 year's depreciation expense being recorded, whereas accumulated depreciation is that permanent or that real account that we keep the balance from 1 year and continue to update it. So we've got year 1 and year 2 with a total ending balance of 11,400. Under UOP, units of production, there's no need to compute partial year depreciation. This method is based on production. It is not time-based. All right, so if we're looking at the depreciation schedule using units of production, we're going to list the kind of property, the date acquired, as before. The method is UOP, units of production. This one has a depreciable base of 8,000, residual of 7, so we're looking at a total cost of 15,000. The depreciation for year end at 12/31/09 is 1840. that is based upon the rate that would have been applied. Now, there is no depreciation in prior years because this one was just acquired in the current year, 2009. So the accumulated depreciation at year ending 12/31/09 is the same as depreciation for year ending 12/31/09. They have put in here that it is 80 cents. 80 cents is per carton is the way. So, and they're basing this on per carton hauled. So this one's not even based on miles driven. The delivery, the van may not have much mileage, but it's hauling cartons, and so it was deemed in this case that that would be a better measure of the cost, the depreciation cost. So that's 7,000 times 80 cents per carton, and we'd have to know how many cartons. So they're saying here that if the van is used to deliver 2,300 cartons, then we would take 2,300 times 80 cents, and that's where the 1840 comes from. All right, that brings us to the declining balance method. So looking at it, declining balance is an accelerated method that yields higher depreciation in the early years and lower depreciation in later years. And generally the declining balance method is used for an asset that will be more productive early in the life of the asset. In other words, more productivity means it will generate more revenue in the first few years of its use than in the later years. The declining balance method, to come up with the annual depreciation expense, we need to take the net book value, multiply it times the straight line rate, times the multiple, and the multiple means what are we dealing with? In this case, we're going to be dealing with double declining balance, so the multiple will be times 2. There's also the 1.5 times declining balance rate, and that would be 1.5 for the multiple. The net book value is cost less its accumulated depreciation. The straight line rate, we're going to have to use that formula that says 1 divided by its estimated useful life to get the decimal, to get the percent for the straight line rate. And that way, when we're looking at the multiple, whether it's 125% declining balance, that would be 1.25, or the 150% declining balance, 1.5. Or in the case of where we're going to use double declining balance, it would be times 2. So here's an example. On January 3rd, Dabco purchases for $65,000 cash equipment with an estimated useful life of 8 years and a residual value of $5,000. What is depreciation expense for the first 2 years under the double declining balance method? Well, we're going to take the net book value times the straight line rate times the multiple. This is $65,000. That's the net book value we start with. And straight line rate, by the way, we started with net book value of $65,000 because there is 0 in accumulated depreciation. So it's cost less accumulated depreciation. Cost of $65,000 less 0 is $65,000. The straight line rate, 12.5%, is because we take 1 divided by 8 years. So 1 divided by 8 is 0.125 or 12.5 as a percent. Times, and we're using double declining balance, so it's times 2. So the straight line rate times its multiple is 25%. So that will give us $16,250 for depreciation using double declining balance in the first year. Now, the net book value for year 2 is to take the $65,000 less the depreciation expense for the first year of $16,250, and we have $48,750 that we're going to multiply times the 12.5 times 2. Or we could have combined these last two and just simply say $48,750 times 25% or 0.25. that's going to give us a lesser amount. This is an accelerated method, so the depreciation starts high, higher than straight line, and tapers down. So this one's 12,187.50. Take note, are you supposed to round it to the nearest cent or round it to the nearest dollar? If you had to round this to the nearest dollar, it would be $12,188. So looking at this, they have it set up here in another little chart. Here's where I would love to use Excel, use a spreadsheet software, and be able to compute this. They're showing you the annual depreciation, the accumulated depreciation, and what they have then is the beginning book value subtract accumulated depreciation gives you year-end book value. That year-end book value becomes the beginning year book value that you multiply times the rate. Remember, it was 12.5% times a multiple of 2. They've just combined it and made it 25%. And they have rounded it to the nearest dollar here. So again, accumulated depreciation, then you're adding the 16,250 plus 12,188 to get 28,438. And then you're taking 48,750 beginning year, subtract accumulated depreciation to get year-end book value of 36,562. The pattern is started. You would just continue doing this. You have to be careful with the declining balance method as you're approaching the end of its estimated useful life. You need to be sure that you do not exceed the depreciable base.